Thank you very much for inviting me and the kind introduction. And I'm quite honored to be at the Peter Carr conference. I knew Peter personally on a couple of occasions we met, and a long time ago he called me when I was on my way back home from a conference if I could explain him more about the conventions that I used in foreign exchange to express volatilities. So that was something that he even didn't know at the time. So I was very happy to explain to him, and there was an exchange that this happened in for a couple of weeks where we discussed that. Very sad to hear that he was first. No, it's okay. So I will talk about today about what are quants doing these days. I can assure you we are not quite replaced by artificial intelligence yet. But yes, I don't even think we're an endangered species. So I will go into some of the things that quants need to know about to work as a quant. And what are the things that you might want to learn about if you want to be a quant in the future. And I will go into some details about market microstructure and how we deal with that. Because nowadays you have already so many models that are established over the years in the market. And the crucial point for me in many cases is that you need to understand the microstructure of your market very well to build a good model to manage risk on such markets. So for a quant to be successful in a financial institution, you need three different skill sets that must come together in order to be successful. For one, there is the mathematical finance part, where you apply no arbitrage principles, stochastic processes. You do risk. You apply these principles and processes in real numerical methods, Monte Carlo, trees, partial differential equation solvers. And you have a couple of numerical methods that you need to know, like optimizers. Matrix calculus was already mentioned today. You have discrete search algorithms that you need to know about. All of this needs to come together. And then you need a lot of technology skills. I would say that the large part of our daily work is about implementing things for the bank, for the trading desk, for structuring. And you need very good implementation skills. So in the past, mostly quants worked with C++ as an implementation language. We at Leonteq, we have a Swiss language, so to speak. Scala was developed in Lausanne. And we use that as an implementation language. It's a nice mix of object-oriented and functional principles. And you need to know about architecture, how things work together, especially how multi-threading works. Now we have implemented some of our methods on graphic processors. So you need to know about how work graphic processors, how is the architecture there, what do you need to think about in order to implement things there. So we are not in the situation like the machine learning community that Google has already taken care of the low-level implementation on the GPU. So you live on a very high abstraction level. For us, it was really to build this from scratch, to implement a part of our library as a CUDA code, as this is the implementation language on the GPU. And to think about things, I will talk about this a little bit later in more detail. And again, on the technology side, you need to understand how the architecture interacts with your numerical methods. Things like cache sizes and level 2 caches will make possibly a difference. And obviously, we work in the financial industry, so you need to know about financial products. You need to understand the language that traders use to talk to each other, to talk to you. Otherwise, it's a bit difficult. So you need to understand how the markets work, and for this you need to learn the language, how the market participants talk to each other. You need to know about the traded products and the conventions that they use. For example, if somebody talks about par swap, you need to understand that this is a swap that prices at 0 at the moment and imply the correct rate to achieve that. You need to understand other things, like for foreign exchange. I already had this as a small example. You need to understand what are the conventions in foreign exchange. So for once, you have the convention that in the foreign exchange market, which is mainly an over-the-counter market, the options are quoted in delta, so they are not quoted in strike. So now the difficulty is, which delta do you actually mean? Because in foreign exchange you have a variety of possible deltas that you can quote in. So you have two currencies involved, so you can either express the delta in the amount of currency 1 you need to buy against currency 2 to be hedged, or the other way around. You need to understand that if you have an option, the premium in the foreign exchange market can be settled in one currency or the other currency. Again, this will influence your delta. So you need to understand these things in order to understand if a trader says he traded in 25 delta in euro dollar, you need to understand what is the convention in this market to understand what is the strike that he actually traded. You need to understand more simple things like at the money. In the equity market, it's rather straightforward what money actually means. But in foreign exchange, it's a bit different. In foreign exchange, at the money means the delta neutral straddle. And again, you need to know which delta he is talking about to arrive at the strike where the straddle is delta neutral. Okay. Then another thing that is very important for Quants, we need to support all the regulatory reporting requirements that we have. So it used to be value at risk. Now we have FRTB coming up. We have some credit risk measures. PRIPS KIT was a very interesting requirement. I don't know if you know the details of this requirement. So at some point, regulator said, in order to distribute a product in the public market, so not the professional market, you need to do a document, 1 page, where you detail the risk of the product. Then there was a regulation telling you at which volatility of the product, which risk category this product falls into. And there was a second part, which is how do you come up with this? You need to take historical returns and put them into your Monte Carlo engine to come up with a volatility from these historical returns. So obviously, now your Monte Carlo engine is not driven anymore by a random number generator that generates the paths, but you need to be able to replace these paths by the ones that you get from your historic returns. So as a quant, you have always interesting new requirements coming from these regulatory changes, and you need to support them. So this is very important. So I will give now some idea what you need to do in a quant department to do implementation of your models on a GPU. This is something that was for us coming quite late. Some other places did this much, much earlier. We are a small team, so we started by looking at a consultancy company that was proposing to assist us. Unfortunately, this was not very fruitful. They had their own view how this should be done, and this was not really compatible with how we thought about it. So in the end, we decided we do it all on our own. So one person for 1 year was just looking at how to do this. So he learned about the tools, how you can actually get debugging messages out of the GPU, how you can load the GPU. And there were some surprising finds, like it's very, very difficult for a modern GPU to really fully load the GPU with tasks. So in the end, we have a ratio of, I think, 4 or even 8 CPUs that do nothing else than prepare the tasks for the GPU to be executed. Okay, so this was quite something that we didn't know before, but if you think about it, how fast the GPU is and how massively parallel it is, this is really, really an eye-opener, so to say. Internally, in the GPU code, you need to optimize memory usage. So you need to decide which variables go into registers that are very fast accessing them. You need to think a little bit about cache levels. You need to think about kernel size, something that people don't usually talk about. Kernel size is how big is your executable, because the GPU has just limited memory. It has a lot of these small computation units, and you need to have a small kernel in order to be allocated a lot of these small computation units. So this is very important to restrict your kernel size. So you cannot do a lot of fancy things there, so you need to really be as small as possible. So all of this is like a journey that we still haven't finished. So we have done some part of our library that runs now on the GPU. But there are other things that we need to still work on where we don't have an obvious solution, because mainly our main products are products that are multi-dimensional, multi-asset underlying derivatives in the range from 1 to 5 years, let's say. And for those, it's quite clear that Monte Carlo, you can naturally parallelize Monte Carlo simulation. But for other things, it's a bit more tricky. And it's sometimes even that you need to go back to the drawing board and really come up with some algorithm for some things that you thought would be available already. So in terms of technology, what we have as a lessons that we learned is you do a library and you have a certain idea of what it should do. The thing is, you need to be super flexible, because you can be sure that 2 or 3 years down the road, there will be new requirements that come from trading sometimes new regulatory requirements. You need to be flexible to react to these new requirements. There are new markets as well that might require different models and then a different approach to valuing products on these. Then we have how do we develop? I mean, it seems a bit obvious for those who have been around for a while in this financial industry. In order to scale, you want that your implementation is state-free and side effect-free. So if you have a function that changes the state of a global variable, this is no good. Huh? You don't want to rely on such things. So you want to have the library to be multi-threading safe. So if you have multiple threads working on some shared memory, you want this to be safe. So no run conditions. You want to be able to not run this library on your local computer only, but you need to distribute it to your compute grid. So often the things that we need to compute will be reports for trading that, let's say, have a couple of scenarios, 20 or 30 different scenarios in terms of spot and volatility moves, let's say. So now you need a way to say, okay, I want to distribute the computation of these scenarios across the book of this trader on our compute farm. So we have a basic net infrastructure, but for example, due to the introduction of the GPU, we had to change the grid code because now the grid has to decide, firstly, do I try to send this to the GPU or is it an easy compute job, so I do it on the CPU? Secondly, I need then to decide if I come to the CPU that feeds the GPU, maybe I can now more cleverly decide if it's heavy enough, Monte Carlo, to send it to the GPU, or is it an easy one that the product just has another 3 months to run, that I can do it myself. So all of these has small changes in the scheduling on the grid. And because nobody else does it, we Quants had to do these changes. The other thing is that we want to have reproducible results. So we have a large test suite of unit tests and regression tests. We really want to be sure that the code runs completely deterministically. That sounds a bit weird, but even for our Monte Carlo that has some built-in randomness, we want to be sure that we always get with the same seed, the same sequence of random numbers, so we can be assured that our regression tests are really regression tests that test the same functionality. And believe me, we have many. I think I counted once, which was around 20,000 different regression tests that we run every night. Then what is quite important as far as possible to separate functions and concepts. So let's say the most natural choice in a financial library is to come up with one pricer for one model for one product. So this will explode very easily. So you need to be a little bit more clever about how you do this. Since we use mainly Monte Carlo for pricing or PTE, we will abstract this. So we say, okay, we have a product. That product can run on observations in a very abstract sense. So now I need to have a model that generates observations. And this is good enough for my evaluation of the product in this Monte Carlo framework. So I take these two apart. And I have different methods. Not all of them are applicable to all products, obviously. And so I need some abstraction there that I can basically have a selector which says, okay, the standard model and the standard method for this payoff is Monte Carlo local vol. But today I don't want to have the standard model. Today I want to have this in stock local vol. So I select stock local vol, and then I can price the same thing with a different model. So the payoff has not changed. Okay, this is quite important. And for this we have as well something that was invented maybe 30 years ago. So payoff language. I think at Leonteq we have the third incarnation of a payoff language. This is something that you do not want to code a payoff, a new payoff, in some Scala code, and then have a release cycle, and then you can work with this payoff. No, we want to have something a bit better. So we want to have a payoff language where a structurer or a trader can define the payoff, like in a language, like in words. And then he can send these words to our engine, and the engine knows how to interpret it and create an asynchronous syntax tree out of it. This will be worked on to streamline this, take out parts that are not needed, and then this payoff will be evaluated through the observations that are generated by the model. So it pays off to actually have this separation. And then you have the benefit, if you have a payoff language, you can try new products on the fly. And if a client wants this product that was proposed with using the payoff language, he can have it within minutes. There's obviously some review process by our risk department, by us, and by the lifecycle management people if this new product will work in this framework. But if it's just a small variation, let's say, this is quite easy. So this is a bit about technology. Now I want to talk about more the part. So in our department we have people who lean more towards technology and some people who lean more towards financial engineering and markets. So I would probably be the second category. And I want to talk a little bit about microstructure and which specific issues could arise here. So one thing is dividends. Often you find that people are not very interested dealing with this topic because when you look into the microstructure, it is quite tricky actually. So how does it work? Let's see if this works. No. Yeah, that's the one. Here we go. Okay. So how does it work? Usually dividends are announced at some point. Then the orange part is when the share is going X. That means in the price the dividend is not included anymore. And then the yellow arrow is when the dividend is actually paid. So between this flag point in time and the orange point in time, you can be pretty certain that this will be the dividend that is paid. And this is not in percentage term, it's an absolute cash amount. So the next dividend are not known, but usually you know the announcement date, you know when they go X, and you know the payment date. But you don't know exactly what it is. Usually you have some analysts who give you an estimate of, and you can come up with a consensus on the dividend amount. And then you see that for dividends far in the future, there are not even estimates. So how do you model this? So you do a little model that says, okay, I say that my dividends are actually composed of a fixed part if I'm close to the X date, and they are usually proportional to the stock price for future periods. And in the middle, I somehow do an interpolation between the two. So, and then obviously you can make a little model that takes this into consideration, and you can actually make sure that far in the future, because this is one of the problems that you face, that the spot goes below your dividend floor. So the dividend floor is the dividend amount that you're going to pay. That means that if you have a fixed dividend in the future, that is larger than your spot price, you would expect in this approach that your spot price would go negative at that point, which is obviously something that you have never seen and will probably never see. So you need to have a model that makes sure that you have a diffusive process for the part where your dividends are proportional. And then you have a fixed part on your stock price that is the discounted future fixed part of the dividend. So this is one thing you want to deal with. The other thing is that you have from option prices, if you have enough strikes, you can actually imply a dividend or a forward, and with a forward a dividend. So what do you do with this? Because this is not the dividend that's going to be paid. Okay? Because this is the gross dividend. So this is the gross dividend that's going to be paid. So in your model, you want to have the net dividend, which is the economic advantage to getting this dividend. So you get the dividend, you pay taxes on it, and this is actually what is the ex-dividend jump. Okay, quite trivial, but you need to know and work this as well into your model. So in some cases you will need to know about the gross dividend. In other cases you would rather want to know about the net dividend. Okay, this is what I already said. So you can make a pure price model, which basically is the price above the dividend floor. You can rephrase the Black-Scholes model in those terms, and you get to a very nice formulation in this pure price process that you can then use in other contexts as well. There's more market structure. So you have here something like the implied volatility, taking into account that during weekends there is no trading activity. Okay. So in a simple model, you could say, okay, my volatility on weekends will be much lower because if there is no trading, there is no volatility. You can say, okay, it's a 10% of what I have usually as the volatility on weekdays. And then you can calibrate this model to match the volatilities that you see on the slices on the dates where options are traded. And then you do some interpolation of these volatilities using the weekend weights. Obviously, this is not the end of the story because you have other special dates as well. So, for example, you could have an announcement of economic data where you think on that date you probably have a bit more activity in the market. So you would raise your relative volatility weight for those days. You would have local holidays that the exchange is closed, so that you would think there is less activity obviously on those days, even though you can trade the share outside on different exchanges as well. It's a possibility. So you want to take all of these, especially for short-dated volatility interpolation, into consideration. And this is not something new, but it's quite tricky to come from volatilities in the market to actually valuation of exotic products using those effects. So you want to be consistent between how you value your implied vols for options on certain days. And this is not something that is very new. So in I think 98, some French companies, they would usually trade options Mondays against Friday, and this basically raises alarm bells if you get all of these trades. Mm-hmm. You have as well, if you are into even more short-dated options, the trading activity within a day. Here, as an example, we have the number of trades per 30 minutes in a week in June 23 for ABB on the Swiss exchange. And you see that there is even intraday a very pronounced pattern, that you have a lot of activity after the open, and you have a lot of activity before the close. And around midday, there's usually a bit of a slow period. And you have days where there is more activity, like this was a Thursday with an announcement coming up. So there is more activity. You want to know about this and take this into consideration if you have to manage very short-dated options. Then you have another thing which became very pronounced with the tech stocks, that you have earnings announcements. And if you look at the volatilities, a few days of maturity in the future, and you have an earnings announcement, you get what is called the Mexican head functions of implied volatilities. If you see this the first time, you think there's probably some arbitrage. So
you can just flip it and there is the whiteboard.
Okay. So you get something like this. First you think this is impossible as a implied volatility. This clearly must be arbitrageable. But in fact you find it's not. And the effect is that a few days before the earnings announcement, the analysts are usually split between very good results, which would then make the stock go up a lot, or a very not so great result, which then would the stock may go down, and this would imply such a bimodal distribution of the implied distribution given by the option prices. And this is real. So for some of the tech stocks, this is very visible. Another issue that we have is if you do not have free markets, but you have something like the Swiss National Bank that does interventions to keep exchange rates in a certain range. So currency regulated markets. So one example is Euro Swiss, as probably a lot of you know. This was controlled by the Swiss National Bank. So Swiss National Bank announced that they want to intervene at a level of 120, so that Euro Swiss would never go below 120. Okay, and they did this for some time, and now you have people who want to trade options on Euro Swiss. So what do? So as long as Euro Swiss stays away from 120, it's probably not so critical. But if it gets closer, you might wonder what is going to happen. You have other examples, dollar Hong Kong. They keep the exchange rate in a band that is quite narrow around the current spot. So there are defined levels and communicated levels, what they do, and they have enough money to buy back every Hong Kong dollar that is outstanding in the world. And you have other approaches to regulate the currency. So Singapore dollar is controlled versus the main trading currencies. And what I'm coming to is, if you have this kind of regulated market, so you know something, and it's not expressed in historic information. So if you look at the Euro-Swiss exchange rate, the volatility is super low. So probably 2-3% at the time. And then how do you come up with a better model than just Black-Scholes or local vol or something like that? So our solution to that was at the time to build a model that takes some economic intuition that this is actually a regulated market into consideration, So we said we want to do some regime switching model. So we want to have the case as the base case. We have a regulated market. So this is basically a process that is flawed by 120. But we want to allow that this breaks. So now comes the economic intuition. What's going to happen if this policy is given up? So our intuition at the time was, okay, probably what's going to happen is not that they will say, okay, we go now to 110, but they would rather say, okay, we give up this policy and we let the free market rule. And then you can say, okay, this is, so now I have two regimes. And I connect them by allowing jumps when the original regime breaks. Then I can come up with a relatively simple model to allow to price and risk manage Euro-Swiss in such a regime switching model. Unfortunately, we were a bit late to implement it, so the depegging happened before we were actually putting this into production, but we had a prediction on what would actually happen with the current market data before it broke. And our model said it would jump down by about 12%. And when it happened, it jumped down about 30% to 0.89, and then came back up again at around 1, it stabilized. So with our 12% prediction, I think it was 12%, we were not entirely wrong. Huh? So here we have some processes with drift and volatility are state dependent. That would guarantee that for such a regime where you have a free floating, where you have a banded regime, that the process can never reach the band. You have like a two-sided band, a one-sided version. Then you have a crawling peg as well, where the process then mean reverts back towards a crawling peg, so a crawling devaluation. So this is something that at the time we saw for Turkey. So they were managing their currency with a crawling peg, as it was called. So here are some of the conditions, how you come to a Markov chain mechanism between these regulated regimes, or transitions between them. And then you have just, so basically what you do not allow is you don't want this regime of the free market after the regulated market to jump back into the regulated one. So this we didn't allow in this model. And you have some conditions on the jump size between during regime switches to make this a martingale. And you have then a set of coupled PDEs that you need to solve in order to get a price of options in such markets. Okay, I think I'm sure I'm through with the slides. Just closing remarks. What do we look for in team members? So one thing that we look for is to be interested in financial markets and what is happening there. To be interested and follow the trends in the technology area. So, for example, what we have not done yet is the move from Scala 2.x to Scala 3, which is quite a big one. But the tools are not that reliable yet in Scala 3, so we're waiting a bit there. So, but you need to follow this in order to know what is coming next. You need to know what is on the hardware side, what is going on there. Maybe there is a new type of technology that we need to support in the future, so we need to know about this before. The big elephant in the room is machine learning. that I didn't mention. Personally, I have a background in machine learning. So I did machine learning in the early 90s. And at that time, everybody was very enthusiastic about machine learning. So I went to a conference in San Diego, I think it was 89. And there was a little survey. What percentage of computers will be neural network based in 5 years? And the cautious predictions were around 20%, the more aggressive one 30%. And the end result was 0. Huh? So it took quite a while to get where we are today. Yeah, we follow this area, obviously, and I have a personal interest there. And we haven't found a very good application of neural networks so far. We use neural networks light in 2-3 areas. So kernel regression, which is neural network-like, some regression methods. But deep learning and large language models, so far, we haven't found the case to use them in our institution. Okay. I hope you get an idea what a quant needs to know and what we do. Thank you very much. You've got some questions?
So I have a question. Thanks for the presentation. And going back at what regards the regulatory impact on valuation, and as well to the intraday aspects of market assessment that you seem to look quite closely in your approach. I have a general interest and curiosity on how you look at trading curves and trading pulses, which are either triggered by automated systems or by external, by specific interventions of the regulators. Do you think it's possible or helpful to factor them into short time valuation for the?
This we have not done. Not at all. Of regulatory intervention, we no.
Is it because you think they're negligible, or because there's no appetite for depth, or there might be?
I mean, there is just very few information about that. I mean, how do you know that this was done by S&P and not by some other market participant? We don't have this kind of visibility.
The potential of a model capturing that. Do you think it's interesting in financial practice, or there's automatic trading curves
not really. Another thing that I did not mention, but which we need to work with as well and support this in the library, is quantitative investment strategies, which goes a little bit into that direction, that you have automatic trade decisions, but you have fixed rules how this is done. So it's a different topic, but we have to support this as well. And this is a bit of a tricky thing, because obviously in QIS you have some illiquid asset where you want to write an option. So yes, you can do that. Then you volatility manage by a volatility target mechanism, what the volatility is. So now how do you do risk management on this? Because you don't have a whole market on the underlying itself. It's tricky.
So open interest in that case. You need to use open interest as techniques to understand the depth of the market, right?
For the spot market, yes, we take some buffer for that. The tricky part is, and we did some study on this when this started. Stochastic volatility, local stochastic volatility, if you assume you knew the volatility surface of the underlying, this is usually not a big problem in these QIS products. What is a problem is jumps. What is a problem is jumps. And you have this very rarely, and then you usually have some fun, which the jumps are like in quarterly. It's tricky. Yes.
Yeah, I have a question and then a machine learning application in connection with it. The question is about advising trading desks on the prices they should be charging for their products based on the number of factors and procedures they want to implement for their hedging. So, for example, if they want to start Vega hedging or other Greek hedging, and they want to implement that, it doesn't come for free. I mean, these things cost money, just like the hedging costs money. And so, do we advise the trading desk of what they should be pricing their products at if they wish to hedge it in this way or this way or this way? Now, in doing that, if you hedge using options, you're going to make a hedge, you're going to trade options, and you're going to buy and sell the options to implement the hedge. You're going to need to be able to mark to market or have access to market prices in a database on which you can backtest the hedge. If you're going to run that hedge, you've got to backtest it, and to backtest it, you need to summarize the market. And you can't summarize the market by saying, just go look up the price, because it may not even be there. Mm-hmm. And so what I had done at one point was said that the implied volatility is a deterministic function of moneyness and maturity. And I can train a GPR, a Gaussian process regression machine, to predict the implied volatility each day from the moneyness and maturity. And it does a good job. I did a paper with Wim in quantitative finance on this, or somewhere. Then you see, if you need to market the option on a particular day, you just call your GPR and say, hey, what's the exit price on this, right? And so for backtesting hedging strategies that actually hedge using options, you need mark-to-market algorithms. And then you can advise desks about how much they should be charging based on the kind of hedging you want to implement. But I don't know whether this is going on or not.
We are too small an institution, I believe, for this kind. We have much more simple questions that traders are asking.
Okay.
One of the things that they're really interested in, how do you look at if the skew that you see in your option prices, if this is going to realize or not? It's a really interesting questions. I have not found a very good answer to that yet.
Yeah, what I find is that many people, they understand that the price of an option comes from the hedge. And they understand that there is a price in delta hedging because you've got to pay for it. Yeah. But then when they go to doing Vega hedging, Gamma hedging, forget the price. Nobody's talking about the price. What is it?
You're right.
It doesn't come for free.
So I think, yes, Vega hedging they do for sure.
Yeah, but you see what happens is that when they forget the price and they do Vega hedging, they put on the position and then they bleed and bleed. Because they priced it at zero, and it's not zero.
Yeah, we looked at that. There was some question around, can you have positive gamma and positive theta at the same time? And if you have a model that allows for some variation in volatility, then you need to look at higher order sensitivities to the implied vols. And you can have a contribution, either to a positive, negative from the Vanna or the Volga that would compensate for that. So this kind of thing we looked at.
Oh.
What do you mean by the skew realizes so exactly? So
this is not an exact question. I still wonder what it actually means. So normally I would say you want to look at what is the covariance of spot and let's say at the money volatility.
Yes.
And if this is predicted in a good way by the skew. Because for the short-dated skew, you have some
Yes.
relationship from continuous noise with
So practically, so this SSR
exactly.
that is close to your target value should be 1 at this point or something like that. Then the
Somewhere between 1 and 2 usually.
yeah 1 and 2. Then
But here you have another problem. How do you measure SSR? On historic data, it's super hard. It's super hard. We did a couple of things that we tried, and it's numerically super sensitive.